Let's be real for a second. What if I told you that most people buy stocks the exact same way they'd gamble at a casino? You know the drill. They scroll through their feeds, spot a hot tip on social media, cross their fingers, and just hope for the best. And then, well, they wonder why they end up losing money. But today, we're going to change that. I'm going to show you exactly how the pros do it. We're going to treat every single stock like a real, breathing business that you are about to own.
Think about it. When legendary investors like Warren Buffett buy a stock, they aren't just blindly clicking a blinking ticker symbol on a screen. No way. They are buying part ownership of a living, breathing company. Imagine someone offered you a 10% stake in a local restaurant down the street. Would you buy it without knowing if they actually have any customers? Or, if they're completely drowning in debt? Of course not. Yet people do this with stocks literally every single day. In this explainer, we are going to completely shift you out of that casino mindset and right into the mindset of a professional business evaluator.
So here is our roadmap. We're breaking down the 15 essential investing indicators into 5 logical pillars. Number 1, the heartbeat of growth and profit. Number 2, efficiency, debt and cash. 3, valuation, paying the right price. 4, the intangibles and trends. And finally, number 5, your ultimate investing checklist. Let's dive in. Pillar 1, the heartbeat, growth and profit.
All right, before we get too deep into the weeds, we absolutely have to look at the money actually coming into the business, and honestly, perhaps more importantly, how much of that money stays there. So our very first indicator is revenue growth. Think of revenue as the company's heartbeat, right? It's the total money coming in from sales. Take company A on the left here. It's growing year after year, jumping from 10 to 12 to 14 billion. That's a super healthy sign. They are clearly attracting more customers. But company B, their sales are shrinking. And here's the harsh reality. If sales are shrinking, a company has to work twice as hard just to stay afloat and maintain its profits.
And that brings us to indicator number 2, earnings per share, or EPS for short. See, while revenue tells us how much money the whole company makes, EPS tells us what you actually get. It breaks down exactly how much profit belongs to each individual share you own in that company. Investors, we absolutely love seeing this number go up over time. Why? Because growing profits usually lead to higher stock prices down the road. It's really just that simple.
Moving on to our third indicator, profit margin. Because hey, making money is one thing, but actually keeping it, that's an entirely different story. Imagine 2 companies that both sell $100 worth of products. Company A keeps just $5 after expenses, while Company B keeps $35. Which one would you rather own? Obviously the second one. High margins tell us a company is incredibly efficient, has killer products, and possesses real pricing power.
Okay, moving right along to pillar 2, efficiency, debt, and cash.
Now that we know the money is actually flowing in, we need to measure how well the management team is actually running the place and handling its financial obligations. So indicator number 4 is return on equity, or ROE. This simply measures how efficiently management uses your money. Look, if you invest $100 and the company earns $20 from it, that's a 20% ROE. Generally speaking, anything above 15% is the benchmark for a really good sign. It basically tells you that management knows exactly how to put your money to work. Next up is indicator 5, which is debt. Now look, debt isn't always the bad guy. Companies actually use it to grow. The real problem is borrowing way too much. Think of it kind of like this. Family A makes $200,000 but only owes $20,000. Pretty safe, right? Now look at Family B. They make just $60,000 but owe $500,000. Who has the greater financial risk? Well, companies are exactly the same way. Having a manageable amount of debt provides essential flexibility, especially when the economy hits a rough patch. Which perfectly leads us into indicator 6, free cash flow. There's this great saying in finance, revenue is vanity, profit is sanity, cash is reality. Free cash flow is the actual physical cold hard cash left over after all the operating costs and bills are finally paid. This is the real money they use to pay you dividends, buy back shares, or pay down that debt we literally just talked about. Strong cash flow gives a company absolute rock-solid resilience.
All right, pillar 3, valuation, paying the right price.
So let's say we found a growing, highly efficient company with plenty of cash in the bank. We should just hit buy immediately, right? Well, actually, not so fast. Because even a world-class, completely incredible company is a terrible investment if you pay way too much for it. Our 7th indicator is the famous price-to-earnings, or P/E ratio. It compares a company's current stock price to its annual earnings. If a stock trades at $100 and earns $5 a share, its PE is 20. Now, a lower PE might mean the stock is genuinely cheap. A higher PE, that often means investors are expecting massive growth in the future. But beware here, valuation should absolutely never be judged by this one number alone.
And that's exactly why we have indicator 8, the PEG ratio. I like to think of this one as the PE ratio's smarter cousin, because it actually bakes the company's growth rate right into the math. Let's say a stock has a high PE of 30, which, looks pretty expensive on the surface. But if its earnings are growing at 30% a year, the PEG ratio sits right around 1.0. A PEG near 1.0 tells you that a super fast-growing stock might actually be fairly priced right now.
So pulling it all together, this crucial point is captured in Indicator 9, Return on Invested Capital, or ROIC. This one is a massive, massive favorite among the pros. It directly measures how effectively management takes the money invested into the business and turns it into actual profit. Companies with a consistently high ROIC, they have incredibly disciplined leadership and the proven ability to create real, long-term value for your portfolio.
That brings us to Pillar 4, the intangibles and trends. Look, numbers are great, but they really don't tell the whole story. Let's step beyond the spreadsheets for a second. This is where we look at the qualitative factors, the competitive advantages, the people running the show, and what the future actually holds. So Indicator 10 is the economic note. Ask yourself, is this business easy to copy? A moat is a lasting competitive advantage that makes a business incredibly, almost impossibly difficult to compete against. It could be a world-famous brand, a totally unique patent, or just a deeply, deeply loyal customer base. The wider this moat is, the harder it is for competitors to cross it and steal their customers.
Which brings us to our next 4 connected indicators, numbers 11 through 14. First up, management quality. You absolutely need honest, long-term thinkers at the helm, because bad leadership can literally ruin great numbers overnight. Next, you want to look for insider buying. When executives use their own hard-earned paychecks to buy shares, that is a massive vote of confidence. Also, look for responsible share buybacks. These actually make your existing shares more valuable because there are fewer of them floating around. And finally, dividend growth. A company that confidently increases its dividend every single year is signaling incredibly stable cash flow.
Now, Indicator 15 forces you to zoom out and look at the big picture. Industry trends. You have to ask yourself a very simple question. Will people need this more in 10 years than they do today? Because listen, even a wonderful company with a fantastic moat and amazing management will struggle mightily if it's operating in a dying, declining market. You want the wind at your back, not in your face.
And finally, Pillar 5, your ultimate investing checklist. Okay, wow, we have covered a ton of ground today, right from the heartbeat of revenue all the way down to economic moats. Let's pull all 15 of these indicators together into an actionable pre-flight routine for you. Before you ever hit that buy button, you must be able to say yes to these core questions. Are revenue and profit growing? Is the debt actually under control? Does the company have a protective moat keeping competitors at bay? Is the price reasonable compared to its growth? And is the management team trustworthy? Notice something here? Not a single one of these involves predicting tomorrow's stock price. They focus purely on understanding the fundamental quality of the business.
Which brings us to our final thought. Warren Buffett famously said, "Price is what you pay, but value is what you get." In the short term, the market is emotional, it's unpredictable, and frankly, it's chaotic. But in the long term, stock prices almost always follow the underlying strength of the actual business. So it is definitely time to stop chasing social media hype and start evaluating real businesses. The more you truly understand a company, the more confident you are going to be as an investor. If you found this explainer helpful, make sure to subscribe for more research just like this, and let me leave you with this one thought. The next time you hear a hot stock tip, ask yourself, are you buying a blinking ticker symbol or are you buying a real business?